If you've been following the news lately, or you're someone that follows these investment type channels or videos and all that kind of stuff, you've probably heard the term yield curve being thrown out there recently. So what exactly is a yield curve, and does this really tell us if a recession is about to hit? Well, let's find out. Hey guys, welcome back to another video. My name is Nick. If you're new here, subscribe down below. We make videos like this a few times a week, and if you enjoy this content, make sure to hit that bell notification as well so you don't miss anything new as soon as we upload it. But anyways, today's topic, we're going to be looking at the yield curve, what it is, and if we can actually use it to figure out if a recession is about to hit or not. So investors love looking at the yield curve and studying the yield curve, and this is because this is known as a potential indicator that tells us when a recession is about to hit the market. A lot of investors use this yield curve as a main indicator to figure out when they should start selling their positions in preparation for a recession. But what exactly is a yield curve? Well, it pretty much refers to the bond market, more specifically the US Treasury, and the curve itself is plotted by taking different term lengths. So you have 2 years, 5 years, 10 years, etc. Now the result of all this data is a curve that typically looks something like this. Now, as you can see here, this chart was taken back in May of this year, so things have changed since then, and that's why it's kind of a topic of conversation right now. But ideally, what you want to see a curve like this, and that looks like this, with shorter term contracts like 2 years being lower percent yield, and higher contracts like 20 years being higher percent yield. But what has been happening recently in the last few weeks, last few months in the markets have been that these short-term yields like the 2 years have been yielding higher percentages, and that is because there's been a lot of selling that's been going on in the bond market. As more selling occurs, yield percentages do rise, similar to dividends in stocks. So for example, if you had Apple stock at $200 per share and they were giving you a 1% dividend, if that stock price drops tomorrow, that dividend yield would increase. But if the stock price increases tomorrow, then that dividend yield decreases. The similar thing can be extrapolated here for bonds and looking at US Treasuries. But now what I want to go through with you guys and show you guys is a yield curve that was plotted back in 2007 before we had the recession. So as you can see here, right before the recession hit, we had a pretty much flat or close to flat curve compared to the typical curve that we saw a few minutes ago, which is what your ideal curve should look like. And if you take a look and research other curves before other recessions, like 2000 for example, it was a very similar story, and that curve as well ended up being pretty flat before the recession hit. So now looking at the data from a few years ago to now, we can see that we are starting to kind of flatten out compared to what it was a few years ago. And this of course is causing investors to freak out and lose their cool, and this is contributing heavily to some of the volatility that we've been seeing in the markets recently. Like we talked about, yield curves is something that a lot of investors look at for a sign of a possible recession looming, and based on what we're seeing currently, a lot of investors are worried that a recession is about to hit. But of course, this isn't the only thing causing the recent volatility. We've had a lot of other factors, the trade tensions, the Fed rate hikes, a lot of other things going on in the market that's been causing this volatility. But the main thing to understand here is that a lot of the big money managers, those hedge funds, they do look at indicators like this yield curve, and they will start moving money depending on what the yield curve says. So when these big hedge funds move those large amounts of money, it does affect stock prices. So now the yield curve in general is a good indicator to look at and to be aware of. But a lot of investors take it a step further and look at the comparison between the 10-year and the 2-year Treasury yields. Investors believe that this indicator of this comparison, coupled with the overall yield curve, gives us a pretty good idea if a recession is about to hit. So we take a look at the screenshot here that I pulled up, we can see that every time the graph dropped below zero, a recession followed pretty much soon after. Now what you'll notice is that currently we aren't quite below zero, but we are getting pretty close to that. However, what could happen is we could have a similar story as to what happened in, say, 1995 to 2000, where we just slowly dropped below zero over the span of those few years, and then eventually a recession hit in 2000. Now, if this happens, this could mean that we could potentially still be fine for another, say, few years, 3, 4, 5 years. But based on this indicator specifically, we are still not below zero. So there isn't as much fear as there could be in the markets right now. But anyways, what I want you guys to understand is that just because we are at lows right now and getting close to that zero mark does not mean a recession is going to hit tomorrow. It could take weeks, it could take months, it could take years for this to actually play out. Unfortunately, there isn't one specific indicator out there that tells you, yes, a recession is about to hit, or no, there's not going to be a recession. And that's because there's a lot of factors that play into a potential recession. However, this is one indicator that I will continue to keep an eye on and will update you guys on moving forward. And I do think that is something that you guys specifically should kind of pay attention to as well. And if you notice anything interesting about that, make sure to comment, maybe shoot me a message, and I can make a video about that. However, what we do need to be concerned about going into 2019 is that if this continues moving lower, the Feds keep raising their interest rates, the trade war continues going on with China, these are all things that will contribute to a potential recession because it will put a lot of strain on the economy and companies specifically as well. But on the flip side, let's not be doomsday here. 2019 could be a phenomenal year for companies. We could see some more record numbers for earnings. We did see a lot of that in 2018. We continue seeing all that in 2019. But again, the market might not react the way you want to. We might see a lot more volatility next year. But what I want you guys to do is position yourself accordingly. You know, don't go all in on positions. Don't be extremely bullish or extremely bearish. Just see what the market tells you, see where there's good value out there, and make your decisions accordingly. Either way, guys, hope you enjoyed this video. This was kind of more of an informative video, but it also kind of addresses something that a lot of you have had concerns about recently. So I hope you learned something. Comment down below if you did. Drop a huge like as well. Don't forget to invest. Don't forget to invest positively, and I'll see you in the next one. Peace.